this week's market update, central banks are in focus as the Fed moves another step closer to normality. The hard work gets underway after last week's Brexit victory, and the Bitcoin bubble inflates even further. The world's central banks are queuing up to get their final meetings out of the way before the Christmas break. The Fed will inevitably be the primary focus. This week's meeting will be Janet Yellen's penultimate before handing over the reins to Jerome Powell early next year, and another quarter-point rate hike is thought to be a racing certainty. The Fed left rates unchanged at its last meeting, despite pointing to solid US economic growth and an improving labour market. There was further evidence of this on Friday when non-farm payrolls emerged slightly higher than expected at 228,000 new jobs last month, and the jobless rate was steady at 4.1%. That makes it very likely that Janet Yellen will go out with another hike, the third this year and the fifth since the US central bank began tightening policy at the end of 2015. Attention will be on what Ms. Yellen has to say at her valedictory press conference after the decision. She's expected to say that gradual rate rises will be justified next year. The Fed has penciled in another 3 quarter-point hikes in 2018. Although the futures markets are a bit more dovish. With wage growth still subdued, just 2.5% last month, the Fed won't be in any hurry to accelerate the pace of tightening. Elsewhere in the world, central banks are even more cautious. The Bank of England meets for the final time this year and is most unlikely to repeat November's quarter-point rate rise, which effectively unwound last year's post-Brexit precautionary cut. With uncertainty over Brexit continuing despite last week's apparent success in pushing through the divorce phase of talks with the EU, the pressure is off Mark Carney to raise rates any further. Wage growth is also low in the UK, and weak productivity is keeping a lid on economic activity. The concern for the bank is inflation, which has hit 3% this autumn on the back of the pound's post-Brexit weakness. But with year-on-year comparisons more favourable going forward, price rises may well moderate into 2018. The European Central Bank, which also announces its policy decision on Thursday, is under a bit more pressure to tighten policy, with the latest round of economic data showing recovery is on track. That said, there's little upward pressure on prices, and with the bank's quantitative easing programme due to taper throughout most of next year, rate rises themselves are likely to be put on hold for a while yet. So, all in all, the cautious approach is likely to continue to support equity markets despite their relatively elevated valuations. The big threat remains higher than expected inflation and so faster than forecast tightening. After years of monetary stimulus, the market reaction to the inevitable tightening phase continues to be the biggest question mark over share prices. And not just equities. High-yield bonds are also viewed as vulnerable to a pickup in growth, rising inflation, and so higher rates. In particular, any success in pushing through President Trump's tax reforms could give the economy a boost. Combined with the first tentative moves by the Fed to trim the size of its balance sheet, the direction of bond yields is likely to be upwards from here, drawing a line under the 30-year bull market for fixed income investments that has continued to attract funds. This year alone, bond funds have attracted $200 billion in the US, while equity funds have moved sideways. If yields rise as predicted, those fund flows could easily go into reverse. The US is in focus for a few other reasons this week in addition to the Fed. There are 3 issues under the spotlight. First, Congress is living hand-to-mouth, passing short-term spending bills to prevent the US government from shutting down. Last week, a bill got approval to keep the lights on until December the 22nd, and already talks are underway to kick the can a bit further down the road into January. Republican and Democrat leaders have been trying to thrash out a long-term deal to fund government through the fiscal 2018 year, which began at the beginning of October. On tax reforms, there's a rush to get the overhaul onto Donald Trump's desk before Christmas. The president will make a closing plea for his proposed cuts on Wednesday. Already, however, concerns are being raised about how the rush to get the reforms onto the statute book will leave a range of unintended loopholes and glitches that will allow companies and individuals to minimise their bills. The The Republican agenda may also be threatened by the election on Tuesday of Judge Roy Moore in an Alabama Senate election. Moore is an evangelical firebrand with a controversial history. Many Republicans in Washington don't want him elected, but if his Democrat opponent Doug Jones wins, it will be the first Democrat win in Alabama since 1992. Now, America does not have a monopoly on political division. Last week's apparent Brexit victory for Prime Minister Theresa May on Friday was barely 48 hours old before the Sunday papers were reporting rumblings of discontent from hardline Brexiteers. They fear that the government has given too much away to the rest of the EU in order to be able to move on from divorce talks to the all-important trade deal to come. Later this week, the EU is expected to confirm that enough has been done on the cost of exit, the future of EU citizens and the Irish border to start talking trade. But for the government, the battle may only just have begun. As ever, the main response to the Brexit drama has been in the currency market, with the pound tracking developments in the talks. Sterling initially climbed above $1.35 after Friday's early morning announcement that a deal had been done, but the pound ran out of steam as the day progressed and it ended up 0.7% lower. The retreat reflected the growing realisation that the ruling Conservative Party remains deeply divided. In less obviously political news, although even here there's a significant political angle, world leaders will gather this week in Paris for the One Planet Summit. They're going to discuss projects and make financial commitments to tackle climate change. French President Emmanuel Macron will be there, as will the President of the World Bank and the UN Secretary General. The summit is being timed to mark the 2-year anniversary of the signing of the Paris Agreement, a landmark international deal to combat global warming. The Paris deal was signed by 197 countries, although Donald Trump withdrew America's support in one of the first moves of his presidency. Elsewhere, the risks of investment were very much in focus. First, in equities, after South African conglomerate Steinhoff, a serial acquirer of other businesses, admitted accounting irregularities and the departure of its chief executive. Shares in the company lost nearly 90% of their value in a week as investors chose to shoot first and ask questions later. In today's highly valued markets, that is increasingly becoming the way, with the average price fall on bad news rising this year as investors become more concerned about a return of their capital than a return on it. The other big potential risk in markets is looking like Bitcoin, the cryptocurrency which saw its value rocket again this week as the first of 2 Chicago derivatives exchanges started trading in futures this week. The value of those futures contracts surged by more than 20% on Monday as a high level of interest saw trading halted on a couple of occasions as systems were overwhelmed. The value of Bitcoin and other digital currencies remains a mystery to those who've not been caught up in the frenzy. And the soaring value of the currencies, up 50% last week alone, has raised fears that a classic investment bubble is inflating. The price of Bitcoin was less than $1,000 at the start of 2017. It's been as high as $20,000 on some exchanges this week. And finally, oil has risen above $65 a barrel, following the shutdown of a key North Sea oil pipeline for 2 weeks. The direction of travel was already positive for oil following the decision by OPEC and Russia to extend their production curbs throughout next year. So the closure of the Forties pipeline was pushing on an open door as far as the price is concerned.